All right. Welcome, everybody. This is Ian Goldsmith with Meridian Link. I would ask each of our panelists to introduce themselves. Let me start, I guess. Ian Goldsmith, I'm SVP of Product at Meridian Link. And I'm joined with by a couple of esteemed folks also from Meridian Link, and then some of the folks from the industry from our customer base. So let's start with David. Why don't you give yourself a quick introduction?
Hi, everyone. My name is David Wazorek. I'm the Group Product Manager for LendingQB, and I've been with Meridian Link for 13 years now.
John?
Hi, everyone. My name is John Cosgrove. My official role with Meridian Link is as a product compliance analyst. I've served in this role for roughly 8 years, and my primary function is to ensure that our entire product offering provides our customers with the means to comply with all applicable federal regulations. I've been exposed to the world of regulatory compliance for about 15 years in total.
Great, thanks, John. Nick, you want to give us a quick word on yourself?
Yeah, how you doing, everybody? Nick Santarelli from Mid-Island Mortgage. I've been employed here for 21 years, so I have a lot of knowledge in the mortgage industry, mainly focusing on the IP side, but working closely with compliance, secondary, and all the facets of mortgages.
Toma, how about you? Give a word of introduction yourself.
Hi, so my name is Toma Garan. I've been in the business for over 25 years. I'm with FlexPoint Mortgage Corporation, and I've been here almost since its inception. We've been open for just over a year, going on 2 years now. And my primary responsibility is system management, everything from LendingQB to processing to funding, to underwriting, secondary, basically developing and coordinating systems. And that's basically it.
Great, thanks very much. So we had a plan for what we wanted to talk about today, and then a small wrinkle got thrown in with Fannie and Freddie's announcement yesterday of adverse market fee, I think they called it. So we're definitely going to talk a bit about that. But I do want to sort of try and stick to our basic agenda. And what we want to do is walk through a couple of different things. So starting with really the focus, by the way, the whole session is sort of on pre and post COVID. How's everyone feeling? And I'm not actually talking about our health. I'm talking about the health of the industry. And really what was happening prior to COVID, and how did COVID itself provide an immediate impact? How are things going now? And then what do we think the long-term impact is? So that's kind of the theme. But I think, given that it's probably top of mind for a lot of us, we should probably just open up with the discussion around how we think the 50 basis point adverse market fee is going to affect anything. I'm not even going to say if it's going to affect anything, but how it will, and whether we think it might stick. There's a lot of drama and yelling about it right now, and what we think the long-term impact might be. So, Toma, I'll kind of throw that at you first. Let you wade in a little bit on your thoughts on that.
Well, from what I'm seeing right now from the investor pools that we're dealing with on a daily basis, that I mean, it looks like it's roughly going to affect things about an eighth to maybe a quarter of a maximum on a rate, affecting the borrower, what we're able to offer to the borrowers. So a lot of the shops that are out there looking at selling APRs, that APR is going to go a little bit higher, or the rate that they're going to be offering is going to be a little bit higher. That's basically the impact that I'm seeing. And I don't think that it's really going to last. I think it's more a reaction to servicing requirements that are not being met by by the servicing companies, wanting to make sure that they're recouping on the early payoffs.
Okay. So your take is that the end result to the consumer will be between 1/8 and 1/4%, but yeah, you don't think that this adverse market fee will stick very long.
Yeah, I don't think that it will.
Okay. And Nick, what do you see as the impact on loans that are in process? But I mean, I think it's probably loans that are in process and haven't locked, that's obviously going to affect the consumer. But how about for the lenders that have locks and now may struggle to move those to investors? Any thoughts on what that's going to look like?
Well, yeah, I mean, if the loan's locked and it's not funded by September 1st, I believe, the lender's going to have to take the hit on the money, and at the end of the day, they're going to have to recoup that cost somehow. So, I think for the foreseeable future, they're going to see a little bit of a uptick in rates, so the lenders can recoup that money. And then after that, no one knows where this is all going, but it's going to be interesting for sure.
Yeah. So just from my slightly selfish perspective, we literally just completed our monthly reforecasting exercise. We forecast volumes because they're a big driver of our business. And just finished it yesterday, and now David's probably rolling around in agony as he's the main driver of our forecast, and he's the guy that's got to reforecast it all super quickly. So, John, what are you seeing from a regulatory perspective? Any sense of why this move was made?
I would, I mean, essentially what Tom and Nick alluded to. I mean, this is more of a reaction to secondary marketing servicing, things along those lines. And as far as compliance impact, obviously you still need to make sure that all facets of the transaction meet all applicable federal and some state level guidelines. But we don't foresee any, changes or anything like that to any of the regulations reacting to this essentially temporary pricing adjustment.
Okay, thank you, David. What I mean, I know that we had quite a lot of anxiety amongst our investor community this morning with the need to suddenly change rules in the platform. And what are your thoughts on how this will impact us?
Sure. So yeah, I think our pricing engineer team has a lot of experience rapidly making changes. The reality is a lot of lenders were already starting to add adjustments to refinance scenarios. We saw that early on in, I would say, around mid-March when a lot of the economy started to shut down. But you saw a major spike in refi. One of the ways that lenders were handling that surge in volume was to add a pricing hit. So there's quite a few requests coming in that our team had to take care of pretty quickly. One thing I'm interested to follow though is the spread between the 30-year fixed mortgage rate and the 10-year treasury. So if you look at charts for that, historically it's kind of trended around a spread of 1.7%. But over the past several months, it's been closer. It's been hovering between 2.6 to 2.2% roughly. So it spiked up and it is starting to trend back down. What that tells me is that there is some room for lenders to eat this hit a little bit. It's not something that they want to do or that they like to do, but I expect initially they'll try and pass it along to the consumer. Which may drive down volumes a little bit in the short term. And then as those volumes are driven down a little bit, I expect the profit margins to go down a little bit as well, which you'll see as that spread starting to decrease between those two rates.
So the theory essentially is that as the spread grows, lenders are raising rates because of capacity issues, so to try to slow down the volume. So the government, out of the kindness of its heart, decided that it would provide that increased spread automatically rather than, or maybe eat into that spread a little bit to help the lenders slow down their capacity. So very generous.
They wanted a piece of the pie, I think, is what it is.
Yeah, I was trying not to directly say that, but yes, exactly. So let's try and get back to the theme that we want to talk about. By the way, just logistically, we're planning on having about a 35-minute conversation. Please, anyone in the audience, feel free to ask questions through the online system in GoToMeeting. There's a faint chance that I may have my technology straight enough that I'll be able to find some of the questions and pose them to the audience. We'll do our best to get through that. But in the meantime, let's kind of continue with our conversation. So, Nick, do you want to take a quick give us a quick sense of what it was like for you guys in early March when the pandemic first hit and you had to sort of uproot your operation. How did that work out for you guys?
Well, I mean, it was, initially it was, everybody had all the uncertainty and everybody just didn't really know what was going on. What we decided to do was, for the people who wanted to work from home, we were able to get them set up from home. We purchased a bunch of laptops, got the proper licensing for remote access, did what we had to do to get them up and running. And we've maintained a core of our essential employees coming to the office. We were able to spread everybody out with that empty space after we had cleaned it and sanitized it. So we have everybody that's now more than 6 feet apart, working at their locations, and it's worked out great. Salespeople have been all working from home, which I'm sure they like to do anyway. And we've been fully operational. I mean, the majority of our core staff hasn't missed a day. So everybody's been, keeping their distance, and it's been a ride for sure. But overall, I think we've done a fantastic job as a company, and the steps that we've taken have been a good part of the success that we've seen during this refinance boom.
Oh, that's great. Really, really glad to hear that. Toma, did you have a similar experience?
Yeah, we definitely did. I mean, in the beginning, the biggest problem that we had were finding out that our employees' internet at home wasn't quite substantial enough to handle all the documents, the phone conversations, everything, the webinars. So getting people, it took a little bit to get people's internet up to speed. But equipment-wise, same thing as with Nick. We had a few core people that worked in the office, spread out amongst the office, and then everybody else kind of went home and worked from home. And then again, it was what you feel comfortable as things lightened up and opened up. Do you feel comfortable from working from home? Do you feel comfortable working in the office? And we have people, even to this day, some of them go to the office and some of them work from home. So
Okay.
same thing.
That's cool. I just want to try and give our audience a sense of what it was like for Meridian Link. And I'll just sort of open it up by saying I joined the company on the Monday of the week that the pandemic hit, and we announced on Friday that we were closing our offices. So I don't have a great deal of experience of working inside the Meridian Link offices. I always feel I have to add the caveat that I was not the cause of the pandemic. I'm sure some people at Meridian Link feel I was, since the timing was. It's a correlation versus causation thing. Let's put it that way. But David, you sort of spent your last 13 years working in an office at Meridian Link. How was the transition out of the office for you?
Sure. It's actually been a lot smoother than you would have expected. And one of the things that I've been thinking about a lot through this pandemic is, in a lot of ways, the pandemic is a tragedy. But if you stop and think about it, the tragedy could have been far worse than it has ended up being. And one of the reasons it isn't as bad as it could have been is because of the technology that exists today that allows people to keep their business open with a remote workforce. Now, that's not true for all businesses, of course, unfortunately, but think about all the jobs that weren't lost because of the new tools that exist that allow people to work from home. And so really for our business as a software company, people were moving frantically to get things set up at home. But after about a week, I'd say we were already hitting a stride. And we did a recent survey with our staff, and we haven't seen any drop in productivity. A lot of people are happy with the setup that they have. There's challenges as well too, but I think it's been a learning experience for a lot of companies that they can operate in a different way than what they thought possible before.
Yeah, and I mean, huge kudos to our IT department for driving a very dramatic change in the business very, very quickly. I mean, Meridian Link was explicitly a no work from home environment. We were a work in the office environment. It was a massive transition. And also, actually, huge kudos to David, who has remained incredibly productive and been completely available 100% of the time, despite going home to a house with a young child and a wife who had a baby about a month ago. So congratulations to David for that, but also thank you for being so engaged and available through all this period. On to kind of a little bit more of the industry side of things. I mean, it's great that I think all of us were able to transition to work from home environment so seamlessly. Toma, did you see much of a change in the way that you serviced your clients and what your customers' expectation was? But obviously there was a massive bump in application volume right in early March, likely due to sort of panic and people thinking they needed cash out of their house to save themselves in case of a job loss, that kind of stuff. But did you guys have any specific reaction to the way you serviced clients as a result of COVID?
Well, definitely, we had to set up a process to set up the mindset saying, hey, everything is going to take 1 to 2 weeks longer than we're normally expected. We're going to have we have to prepare them to prepare their employers to have easy access via not just phone, but via email for verification of employment. Are you employed today? And not income verification, just are you employed today? Are you, it's like 3-4 times throughout the process of are you still employed, especially when Fannie Mae opened up the doors and said, oh, by the way, when we buy your loan, the borrower better be employed at the time we buy it, not at the time we fund it. So now we're doing all these extra employment verifications, things like that, letters of explanation from themselves or even from their employers, saying, are they being affected? Is their income, they're going to be a drop in their income or their hours, things like that. We had to definitely get people prepared. And also when the furloughs came in, and the mortgage furloughs were being offered, having to tell them, just because it's being offered, if you can pay it, keep on, don't go into a furlough because that might affect your loan. So just different conversation, different understanding, and the expectations, the notaries, appraisers, things like that.
Yeah, I'd started a refi in that same week that I joined Meridian Link, and it was definitely an interesting process going through that for sure. Meeting a notary on our front porch and signing documents outside. I guess the Bank of America is still not crazy about e-notarization. Nick, I'm curious, Toma talked about VOE and VOI. Is that something that you do yourselves as an originator, or do you outsource that and use a service or any kind of application for driving that stuff?
We do all that stuff in-house. We don't outsource that stuff to a third party. We contact the employers and get that, send out those verifications and have to get that stuff back. Those kind of things, as well as the uncertainty of the towns and the appraisers, the borrowers not letting the appraisers in the house, and all of that was a very weird time initially, because we weren't sure if the borrowers were going to let the appraisers in the house to do the appraisals and whatnot. We were hoping for more appraisal waivers, obviously, and I think they were a little bit more lenient due to COVID for that. But when you're looking at this as a whole, I think lenders have to be really nimble, and they have to be able to see what's in front of them and be able to sidestep and kind of go down a different path and think outside the box, right? So we weren't set up for e-closing. So to get e-closing done initially was such a daunting task with what's going on. It was just relatively impossible. So what we decided to do was we were able to FaceTime and Google Duo and Zoom with the borrowers to watch them sign the documents. And we recorded that, and we were able to use that as like an e-notary, quote unquote. So we were able to get those loans closed, and a lot of the things that we needed to do, we were able to get done.
That's great. I was actually really hoping to get John's perspective on what the regulators did immediately after COVID, but I'm cautious of time a little bit, so I'm going to skip to our next section And we'll actually, John, if you feel like answering this in the context of what happened immediately after COVID, feel free. But if you also want to look at sort of now and how you see regulators reacting to the pandemic, we'd love to get that perspective.
Yeah, certainly. So once COVID took hold, originally lenders were really forced to make adjustments on the fly to accommodate obviously rapidly changing lending and servicing environment, which in turn left questions about whether or not said accommodations were in fact compliant with a given regulation. As a result, regulators went into this assistive mode, if you will, deeming this a flexible supervisory and enforcement approach, which the Bureau essentially provided commentary in the form of frequently asked questions and advisories to ease lender and servicer concerns. In the end, it's possible for some of this guidance that's been provided in frequently asked questions and advisories to lead to regulatory amendments. What's happening now, I mean, there was obviously a number of regulations that were in the pipeline at the beginning of 2020, and all of that was essentially put on hold due to COVID. But what we've seen is that, however, over the past month or so, regulators kind of shifted back into their rulemaking mode as things start to stabilize. So many of the initiatives that were started earlier in this year and prior to 2020, in fact, have kind of been resurrected. Some of the key initiatives that are on the horizon would be the general QM definition update and expiration of the GSE patch. For those that are OCC regulated, Community Reinvestment Act modernization, there's a final rule that was published not too long ago. Early implementation, although that's in 2021, a lot of lenders are back on track and gearing up for that. State and federal remote online notarization legislation. There's many state legislative efforts. I think 26 states to date have actually enacted state level RON legislation, and there's also a federal bill called the Secure Act that's currently in the Senate that would essentially standardize RON across all states. So yeah, there's a whole host of stuff in the pipeline. The two big ones I would say would be qualified mortgages, GSE patch expiration, and RON legislation would be the two areas for many to look out for. I think those will have obviously an impact to lenders as well as borrowers.
Okay, interesting. David, what do you see with? Are there any kind of common themes across our customer base? I mean, I know we've been kind of accelerating our movement towards e-closing. Is there anything in particular you wanted to kind of address in that area?
Sure. So one of the things that we've been seeing going on through our customer base is a lot of the programs that had started to go away. They've made a gradual comeback. So you're starting to see non-QM return a little bit. Some of the temporary pricing overlays that were put in place to minimize risk have been eased back some. With regards to things like e-closing, also with regards to things like a digital point of sale system as well, kind of what was seen as a competitive advantage perhaps previously, I think it's starting to be seen more and more as table stakes just to play the game. And so we're seeing a lot of interest from our customer base that maybe we're on legacy POS systems looking to adopt one of our more modern solutions, either our in-house one or through one of our POS vendors. So it's one of the things that COVID has done is it took trends that were already in place and kind of accelerated them and brought them front and center to the present.
Okay. I mean, Tomo, forgive me, I should probably know, but are you guys engaging in any kind of e-closing work through any of our partners or through us?
No, not at this time, just simply because right now the investor pool that we're utilizing isn't accepting them.
Yeah.
So that's the other aspect of it. It's one thing to get the counties to accept e-closings for recording documents, and it's another thing to have the investor pool that actually is accepting the product at the end.
Okay. And I guess, John, that's do you see anything in works that may accelerate that?
Yeah. Actually, just in June, Ginnie Mae went ahead and announced that they would roll out an application process for lenders to apply for what they call a digital collateralization program. And I'm actually looking at all of this now. There's several appendices along with main documentation that Ginnie Mae published. I think it was early last month, but they're working on accepting digital collateral in addition to Fannie and Freddie. So obviously there's a greater pool of investors who will now accept, e-notes or digital collateral. So that can definitely help, with the complete digital mortgage experience.
As Nick, as a lender, would whether an investor accepted e-closing or not drive you guys to work with them more than others, or is that not really relevant for you?
That's a tough question for me to answer. I mean, I'm not exactly sure how to answer that one again.
Okay, that's fair. I mean, I guess it's such a which investor you choose is so dependent on the product they're offering and the rate, and everything's about margin. It's for those of us in the vendor space trying to offer technology solutions, we're always looking for that lever for what would encourage someone to use our solution or our partner solution versus somebody else's. So it all gets kind of intriguing. Let's move on to like lessons learned from the pandemic and sort of step into a bit of what's next. So Nick, did anything come up for you guys that you think you'll be able to carry forward in the way that you do business?
Well, yeah, I mean, normally we were getting, before COVID, we were getting all our closing packages wet signed, and that's all the closing documents and the notes, mortgages, etc. What we shifted to was we worked with our doc vendor in LendingQB to allow us to only send out the closing package for the documents that can be e-signed, okay? And then we're only sending the borrower an overnight FedEx of the documents that need to be wet signed. So instead of them, having to do a FaceTime Duo, etc., for 2 hours to walk them through the documents, they're allowed to e-sign them, which has drastically reduced the time that our staff works with the borrower to get the loans closed. So that's one thing. The second thing is we're very happy that we've chosen a lot of our cloud-based vendors rather than keeping things in-house. Because if you kept things in-house, it would be a logistical nightmare to get everybody the access that they need to do their jobs. And that goes to our email, our internal chatting, the LOS. I mean, everything is all basically cloud-based. If we were still dealing with paper like we were prior to TRID, it would be an absolute disaster.
Yeah, it's still hard for me as a consumer on the end of the mortgage business to not think in terms of paper. I still have the closing packet on the end of my dining table here where I work, and the only reason it's still there is because I don't know if I'm strong enough to lift it off. B of A does like their paperwork. I'll say that for sure. I'm actually going to skip forward to a poll and open that poll up for the audience while we continue on with the conversation. Oops, sorry. Ashley, if you would open the poll up, that'd be great. And Toma, while we're continuing, what happened here? A second. Interesting. I lost the video section. All right, never mind. So Toma, while we're continuing, can you kind of touch on anything that came up for you guys as a long-term lesson learned?
Well, definitely. I think I'm in the same. We're basically in the same boat as Nick in the sense that the overall benefit of being cloud-based and having the ability to onboard people quickly and developing a smoother onboarding process to get people up and running. It's definitely helped improve that piece because like we mentioned in the beginning with the having to get people set up at home for remote locations. That's kind of really the part that's really changed the most for us because we had some remote employees before, but the definite consensus was in office, everybody work in office. And I think that's really helped. But as in overall, like lessons learned is the biggest thing would be don't put all your eggs in one basket. So, you have your favorites that you like to sell to, But don't forget that there's other there's other vendors out there, other investors out there, other people out there that also have similar product line. And one of the things, the knee-jerk reaction that we encountered with some of our investors is where they all of a sudden just threw in 4% LLPA on everything. So it's like, oh, you want a 5% interest rate? Sure, it's going to cost you 3 points. We're not getting rid of the program. We just don't want anything right now because we don't know what the market is going to do. We don't know how it's going to affect employment. So while other companies that we were not as familiar with, that we only did a little bit of business with, we're still taking away. So that's kind of like the biggest thing is, don't put your eggs in one basket. Always keep the relationships and always keep the your knowledge base fluid with all the investors that you're dealing with.
Yeah, I mean, it's definitely it's been super interesting from our perspective. We obviously have quite a lot of data from a lot of lenders, both on the consumer lending side and then the mortgage lending side, and the reaction data-wise was really quite different in the two sides of the house. Mortgage actually saw a pretty immediate uptick when the pandemic first hit. March was probably our largest application volume month ever. Now, the pull-through wasn't as good in March for across our lender base, but it was still pretty ridiculous number of applications came in. Whereas in consumer lending, there was a sharp dip. As basically consumer lending in our world is largely driven by vehicle, and all of a sudden no one can go to a car dealership. So that was really interesting, sort of see the differences there. David, what about from your perspective as you look across our set of lenders? Do you sort of see any consistency in the way any behavior is changing?
Sure. So I think one thing that this pandemic really demonstrates is that there's that old saying that necessity breeds innovation. And I think that we really are seeing that with this pandemic. And when I say innovation, there's the technology side of innovation, but then there's also the behavioral side of innovation as well. And within behavior, there's behavior of companies, but then there's also behavior of consumers or the borrowers themselves. And just anecdotally talking with friends and family, I'm seeing them adopt technology that I would not have expected them to adopt. I mean, there's parents and grandparents who are keeping in touch with people over video conference calls, and they're doing all of their shopping online. So like I kind of mentioned earlier, there was a lot of trends already in the works with mortgage, and what I expect from COVID is that it's really accelerated a lot of those trends. It's provided the impetus for it, and I think looking ahead to the future, I don't think the world will ever go back the way it was. I mean, some things will return to normal, but then I think we've, as a people, we've learned things going forward, and I think it's forever going to change us. And a lot of the ways that we've changed, it'll be for the better, I think.
Yeah, I think there's definitely an element of new normal as opposed to returning to the old normal. We do have a few questions that are sort of popping in. So actually one note, which is kind of interesting on the subject of our first conversation about Fannie Freddie adverse market fee. Apparently, according to MBA's Action Alliance, there've already been almost 19,000 letters to Congress in opposition, which is pretty quick in one day.
Yeah.
I mean, I could ask an unfair question, and I will. I'm actually going to ask John an unfair question. What do you think the odds of this sticking are? Do you think this is likely to get reversed, or is there just absolutely no way to tell?
I don't think it'll be reversed. I think this policy will be implemented, but as the other guys alluded to, it's probably a temporary deal. So I think that's something to consider. If this were more of a permanent push, then obviously I think there would probably be more interest in lobbying against this. And 19,000 letters, no doubt, in a single day after this release is pretty phenomenal. But just like we see whenever the CFPB puts out rules and asks for comments. It's very seldom that, you know, these federal agencies react to the commentary and make wholesale changes to policy.
Can you define temporary? Is it temporary as in a year or a month or a day?
That's really hard to say because COVID makes this such a volatile environment. And I think that all of this is really based on risk. So as the, you know, risk appetite is suppressed by investors, and obviously I think there's going to be this need to keep pricing in place. But once the market starts to loosen up and some of this risk is mitigated, and, you know, there's declining of COVID cases and things start to get to back to normal, so to speak, then perhaps there might be a reevaluation of this pricing. I just don't think it would be permanent, because if guys, correct me if I'm wrong, but there have been pricing adjustments, not to this extent in the past, based on market reactions like we saw with the Great Recession, 2008, 2010. But those pricing adjustments weren't anything that were left in place. I mean, once things started to get back to normal, they start to pull back some of this stuff.
True.
Nick, I mean, one of the questions we've had is, and a bit hard to quantify, but what's the general level of concern? I mean, is basically COVID now something that's just sort of happened and it's not really having an immediate impact on the core of your business, or do you remain quite concerned about a lasting effect of the pandemic?
Well, you know, that's a good question. You know, you always have to take a look at, you know, everything that's happened and all the changes that have been made. Yeah, I do think that the changes are, like David said, are going to be beneficial overall down the line. But the impact that this has had on employees' personal lives as well as their business lives has been astronomical. I mean, you know, putting off aside the kids, you know, for the employees that have kids, those kids, come the start of the school year, they're going to be going through a whole new set of emotions. And now employees are going to have to be dealing with that. And that, I think, is going to play the next big role in how the employees react to COVID.
So your focus is, as it should be, is more on the employees of your own company and their well-being, and obviously that's
the most important.
All of our and all of our employees are regular people, and they probably also are the kind of people that deal with as your customers. So your customers must be going through the same kind of thing. But one of the things I think that has surprised me a little bit over this whole thing is that it just doesn't seem to have slowed people's appetite for continuing to drive their financial life. So
that can't come to a halt. You know what I mean? You know, the financial life can't come to a halt. That's just, if that cogwheel stops spinning, we all have problems.
Right. Yep. David, this is really pretty specific for you. Any idea when PML will have the 5% hit implemented?
As soon as possible. I know that they're responding to changes in investor rate sheets as we speak.
I should point out that David is the master of the non-answer to a roadmap question. So, so let's see. We had a couple more questions coming in. Let's bounce back to that in 1 second. Yeah, Toma, what do you think about where things are going to go from the perspective of forbearance? I mean, that feels like it could be a pretty significant impact at some point in the future. But what's future?
Well, the thing is that we're already starting to see a small percentage of people that we're coming across that are wanting to take advantage of the lower rates, and we're finding that they've accepted a forbearance, and for no other reason than just simply because it was offered to them, and therefore we're at a standstill. Okay, you need to now fix the forbearance, get yourself back caught up. So we're already starting to see a little bit of that, of what happened in 2008, where you had the people that were not making their payments because they wanted a modification that their neighbor got, not because they can't afford the payment. It's like, I want what the next person has. This is being offered. And I think trying to get the population and the customer base to change that mindset is going to be the most difficult part. moving forward over the next 3 to 6 months.
Okay. I'm not even really going to ask the next question because I think it's a little unfair. But I'll allude to it and then ask for prediction. So basically the question was when is the NBA forecast going to end? Which is a little harsh. Do you, you know what? I'll start with Nick. Do you have any kind of crystal ball that do you foresee an immediate end to the refi boom, or where do you see things going, or is it just too hard to even begin to touch?
I mean, I think it's way too hard to tell at this point. There's way too much uncertainty in the government with the election, with the COVID. There's just way too much uncertainty to even try and predict what the next 6 to 8 months, 12 months is going to bring. Especially with the forbearances like we just talked about. Once those forbearances, they come due, and people don't have, those 4 months payments, what's going to be next? We don't know. So that's going to be, I think it's impossible to predict, in my opinion.
Right. Toma, do you want to take a stab at it, or are you going to chicken out on that question like the rest of us? Because I'm not willing to answer it either. I'm not throwing you under the bus, Nick. It's not something nowhere I'd be willing to go.
Well, let's just say that I think that Fannie's that 50 basis points LLPA is a reflection of things to come. I think that EPO, the fear of the EPO is the thing that's going to really be driving it more than anything else. I think everybody's trying to forecast and trying to slow down the refinance process, and simply because of that. But when it's going to end, when the refinance, I can sit there and say we have a good 18 months of refinances to go and still be wrong.
Yeah. Wrong in either direction.
Exactly.
Yeah, it's we've just been through a very interesting reforecasting exercise where we're essentially remodeling the way we do some of the forecasts. We've historically been a bit too rooted in the industry analyst forecasts, and now we've sort of done a study of historical trends in the forecasts and how they move over time. And we're applying some of that, and definitely a little frustrating to have essentially finished that work and then had a massive cat thrust amongst the pigeons on the eve of publishing it. But that's okay. So that's why David doesn't get any sleep. That and a new baby, I guess. We're actually at the end of our time, a little bit over. So I had a couple of announcements, but I do want to kind of continue with the conversation. Maybe one more question before we end, but. So just congratulations to Brian Anderson with the University of Hawaii FCU. You're the winner of a $50 Visa gift card. We'll reach out to you with instructions on how to collect that in a touch-free COVID environment. So we'll be good with that. And then finally, before we end, I just want to make sure that there is a 3-question survey. We'd love to get the survey to get your answers to let us know what you think of us. Or I should say what you think of the webinar. We won't take it personally. I might, but we'll see. So I think we probably have time for one more question before we have to wrap. Let's see. I'm trying to pick a sensible one here. I mean, I think there's a lot of sort of commonality through the questioning around rates, and obviously I think it's we sort of touched on that in terms of looking at when refinancing might end, but how I guess for the panel, how much sensitivity do you think there is in to the rates? Would another 50 basis points essentially stop the boom completely? Where is there a boundary? Is there a level that we can think of? David, I'll throw that one at you for now.
Sure. I think where we're at right now, the market is extremely sensitive to rates. Essentially, the economy as a whole has become addicted to historically low rates that have been trending down over the past 50 years. And I think, you know, when you're talking about a quarter point interest rate decline when rates are only 3%, that makes a much bigger difference than a quarter point rate decline when rates were at 8%, for example. And so very small movements in interest rates can result in very large differences in the behaviors of consumers.
Yeah, I think that makes perfect sense. You know, with that, I think we will wrap. We're at time. I really want to thank Toma and Nick for taking time out of their busy schedules, particularly in the middle of what's promising to be the highest volume month in recent history. I know it's tough for you guys to step out of your job, so thank you so much for joining us, and I'm sure our audience appreciated that. And thanks also to David and John for taking time to give us some of your insights. Finally, thank you to the audience for taking time to join us. I really appreciate everyone's time, and with that, we'll let you all go. Thank you all.
Thank you.
Thank you.